You've moved past the absolute basics of trading, and now you're looking to optimize your strategy and capital as you scale up. The internet is full of simplified advice, claiming one market is easy while the other is impossibly hard. But the reality for an intermediate trader is much more nuanced. Both Forex and options offer serious leverage and high profit potential, but how they handle the risk to your capital is completely opposite. Now, looking at this comparison matrix, we have two distinct operational structures. On the Forex side, the appeal is direct execution. You get massive liquidity, meaning your trades are filled almost instantly at a fair price. On the option side, the draw is built-in capital protection and strategic flexibility. You know exactly what you stand to lose before you even enter the trade. By the end of this video, you'll have a clear framework to determine which of these structures actually fits your trading style. Long-term profitability relies on matching your psychological discipline with the correct market structure. Before we talk strategy, we have to look at the core distinction in what you are actually trading. In Forex, you speculate directly on an exchange rate. In options, you are buying a derivative contract about an underlying asset. Forex operates as a straightforward two-dimensional problem. Your entire focus is on predicting the direction of the price and the time it takes to get there. This line chart shows exactly how direct Forex analysis works. You track price moving up and down against a horizontal axis of time. This visual simplicity can be a trap. Success demands relentless consistency in your technical analysis just to survive. With options, correctly predicting the price direction is no longer enough to guarantee a profit. That is because options are governed by multi-dimensional risk metrics known as the Greeks, variables like delta for price sensitivity and vega for implied volatility. This radar chart tracks the added difficulty. Your success now depends on balancing time decay and volatility alongside price movement. This is a frustrating reality for new options traders. You can be right about price direction, but still lose money if metrics move against you. Forex tests your ability to execute consistently in a simple arena, whereas options demand you account for multiple shifting risk factors at once. When you're trying to scale a smaller account, how you manage your capital becomes the most critical distinction. Both markets offer leverage, but they operate entirely differently. Forex brokers offer massive leverage, sometimes 1 to 100 or more. A tiny initial deposit allows you to control a huge global position. This graph illustrates the danger. You amplify profits on a small move, but a sudden shift wipes out your account just as fast. Without a strict stop loss, Forex carries open-ended risk. A single mistake triggers a margin call, liquidating your entire balance. Buying options provides an entirely different, inherent form of leverage. By paying a relatively small premium upfront, you buy the right to control a large block of an underlying asset for a fraction of what it would cost to own it outright. Looking at this risk profile, the downward loss curve abruptly stops. If the market crashes, your loss is capped at the premium paid. You know your absolute maximum loss before entering the trade. This structural safety provides psychological comfort that Forex lacks. Forex leverage demands unforgiving, systematic discipline to survive. Options buying provides structural, built-in capital protection. But the capital protection in the options market comes with a severe hidden cost: the ticking clock. This is known as time decay, or theta. It is a silent metric that actively erodes the value of your contract every single day you hold it. Just like this block of ice melting under a spotlight, your options premium is constantly shrinking, even if the underlying asset's price doesn't move. This forces options buyers into high-conviction, event-driven trades. The price move you predict has to happen quickly, or your investment expires worthless. That urgency is a stark contrast to the systematic trading horizons of the Forex market. In Forex, you don't have a hard expiration date. A trade thesis can be held open for days or weeks, allowing the market to play out as long as you maintain your margin requirements. Options force a hard deadline on your strategy to keep your risk capped. Forex gives your trades room to breathe, but you accept open-ended risk while you wait. Choosing your market rests entirely on evaluating your personal psychology, not chasing phantom profits. To make that decision, we need to map your primary trading priority. This decision matrix breaks it down. Starting from your primary priority, we split into two distinct paths: direct execution or probability strategy. If you are the executioner, you thrive on deep liquidity, rapid entries, and analyzing direct price action. If you have the strict emotional discipline to manually cut your losses and manage open-ended risk, your ideal path is Forex. But maybe you are the strategist. You prioritize capital protection and enjoy analyzing complex, multivariable data. If you prefer accepting a hard time limit in exchange for knowing your exact maximum loss up front, your ideal path is buying options. Identifying your theoretical profile is a great first step, but it means nothing until you prove your edge in a live market environment. The smartest way to test your chosen path is to use FXNX's advanced charting tools and open a zero-risk demo account. Utilizing a simulated environment with institutional-grade tech is the best way to master these market intricacies and confirm your psychological fit, all without risking a single dollar of your real capital.